Namaskar. Welcome to the third podcast of Tax Concepts. Our topic for today is tax deduction at source on benefits or perquisites in respect of business or profession. It has been introduced from 1st of July 2022 by insertion of Section 194R by the Finance Act 2022. In the first section, I will place before you the context of tax deduction at source. Withholding tax, called the tax deduction at source in India, and I will call it TDS in the podcast, is an important tool of tax collection as well as tax administration. The comparative ease of compliance and a less apparent pain in payment of TDS by the taxpayers in comparison to advance tax, as well as the self-assessment tax, has driven a number of nations to increase the role of TDS in tax collection. In a widely quoted research paper published in 2014, Professor Niels Johansen of the University of Copenhagen has outlined how imposition of TDS on interest earned by residents of European Union from bank accounts in Switzerland under the European Savings Directive of 2005 led to reduction in flow of suspect funds to the Swiss accounts. So TDS may even play a wider role in checking tax evasion, particularly when tax authorities are capturing more and more digital financial transaction data of taxable entities. India has followed the same pattern. Over the years, the TDS has become the dominant mode of collection of direct taxes. TDS contributes anywhere between 40 to 49% of the annual direct tax collection in India. To quote from a CBDT press release dated 17th of March 2022, TDS contributed 686 lakh crores out of net direct tax collection of 1,383 lakh crores as on 16th of March 2022. Thus, TDS has contributed nearly 49% of the direct tax collections of India in the financial year ending on 31st of March 2022. So this is the context, and this is the significance of TDS, which led the legislature to expand its ambit and to insert a new section 194 in the Act for deduction of tax on benefit of perquisites in respect of business or profession. The explanatory memorandum of the Finance Act 2022 explains the rationale of 194R in four salient points. The first is to prevent the underreporting of benefits and perquisites by the recipients. And if I may read from the memorandum, as per clause 4 of section 28 of the Act, the value of any benefit or perquisite, whether convertible into money or not, arising from business or exercise of profession, is to be charged as business income in the hands of the recipients of such benefit or perquisite. However, in many cases, such recipients do not report the receipt of benefits in their returns of income, leading to furnishing of incorrect particulars of income as well as underreporting of the income. The second rationale is to widen and deepen the tax base. The insertion of Section 194R to the Act provides that person responsible for providing to a resident any benefit or perquisite, before providing such benefit or perquisite, to ensure that tax has been deducted in respect of such benefit or perquisite at the rate of 10% of the value or the aggregate value of such benefit or perquisite. The purpose is to bring into tax net all those who receive such benefits or perquisites above the specified limit. The third point is to note that Section 194R introduces the concept of person responsible for providing benefits or perquisites, and it means a person who provide such benefits or perquisites. And in case of a company, it is the company itself, and it includes the principal officer of the company also. Fourthly, the memorandum also lays out that in a case where the benefit or perquisite is wholly in kind or partly in cash and partly in kind, but such part in cash is not sufficient to meet the liability of deduction of tax at the rate of 10% of the aggregate of benefits or perquisites, then before releasing the benefit or perquisite, it has to be ensured, and this phrase may be noted, it has to be ensured that tax has been paid in respect of benefit or the perquisite. In section 2, we deal with the issue of deductor and deductee under section 194R, and we explore what is the significance of person responsible for providing benefit or perquisite and the phrase any person in the section 194R of the Act. Subsection 1 of section 194R provides that any person responsible for providing any benefit or perquisite is to ensure that TDS has been deducted in respect of such benefit or perquisite. The primary duty here has been cast on the provider of the perquisite or the benefit and not on the payer. And this is a significant point to note. The provider and the payer may be the same person, but situations are possible where the identity of the two is separate and distinct. For example, a company agrees to arrange foreign tours for its dealers and distributors who have achieved specified targets. It is the company that has to comply with section 194R, not the tour operator or the hotel or the airlines. It needs to be emphasized that definition of person responsible for paying given in section 204 of the Act will not have any application for the purposes of section 194R. The phrase any person is also used in section 194R1 of the Act. It would suggest that the deductor can be a resident or a non-resident person. An alternate view is also canvassed sometimes, and it runs on the lines that section 194R does not have any provision along the lines of explanation 2 to section 195. It implies that a non-resident person who provides the benefit or perquisite to a resident will not be liable under section 194R. In my opinion, the alternate viewpoint is not the correct interpretation. The word any person should be interpreted as having a vast and a wide sweep, subject only to limitations in the text and context of the provisions of section 194R itself. The only exclusion placed on the phrase any person is expressly stipulated by the third proviso to section 194R, and it is in respect of specified individuals or HUF. So I would recommend that the phrase any person responsible for providing any benefit or perquisites admits to no limitation or exclusion except those expressly provided by the third proviso of section 194R1. I will clarify few related issues at this stage. Tax is required to be deducted under section 194R if the benefit or perquisite is provided to a resident person. Firstly, if an employer-employee relationship exists, then tax is deductible under section 192 and not under section 194R of the Act. What if the recipient of the benefit or perquisite is a non-resident? Will tax have to be deducted under Section 195 because 194R is not applicable to a non-resident? It may be noted that Section 194R does not apply to a sum, and its ambit is limited to benefit or perquisites covered by Section 28(4) of the Act. It covers only benefits and perquisites that are earned in carrying out business or through a profession. In contrast, Section 195 applies to a sum. In Commissioner of Income Tax versus Shri Ramavarma in 1991, Honorable Supreme Court, in a case reported at 57 Taxmann 149, interpreted the word sum to mean any sum of money, and the court held that the sum does not include donation of shares. So it may appear that Section 195 does not provide for TDS from a benefit in kind. This position has been clarified by the Supreme Court in another judgment reported under the name of Kanchenjunga Seafoods Limited versus Commissioner of Income Tax and reported at 192 Taxmann 187. In this case, Supreme Court held that payment in kind to a non-resident would attract TDS under Section 195 if such payment in kind is in substance and reality a receipt of value of money by the non-resident. So to sum up the issue, benefit or perquisite in kind provided to a non-resident would ordinarily not attract TDS either under Section 195 or Section 194R, except where the receipt of benefit or perquisite in kind is in substance and in real terms nothing but a receipt of value of money by the non-resident. In such circumstances, Section 195 can be evoked against the non-resident. In Section 3, we examine what is the significance of the phrase to ensure that tax has been deducted and how it plays out in different scenarios. Section 194R is unique in one significant way. It casts an obligation to ensure to deduct tax and not to deduct tax as in the case of other TDS sections. Two other TDS provisions, which apart from Section 194R use the verb ensure, are Section 194B of the Act, which deals with winnings from lotteries or crossword puzzles, and newly inserted Section 194S, which deals with payment on transfer of virtual digital assets. The critical point is to read a meaning into why the legislature, in its wisdom, provided for difference in the main provisos of Section 194R1 in comparison to Section 194B and 194S1, particularly when the first proviso to Section 194R is similarly worded as the proviso to Section 194B as well as proviso to Section 194S1. In my opinion, the usage of phrase to ensure that tax has been deducted indicates that Section 194R1 does not cover perquisites and benefits that are wholly paid in cash or money. This is a very significant point that needs to be emphasized, that the ambit of Section 194R1 is limited and it does not cover perquisites or benefits that are wholly paid in cash or in money. For recommending this, I draw sustenance from a Karnataka High Court judgment in the case of Commissioner of Income Tax versus Hindustan Levers Limited. It is a 213 judgment reported at 39 Taxmann.com 152. The decision of the Karnataka High Court was rendered in the context of 194B, but it will most certainly apply to sections 194R also. We can explicate the whole process through the four possible scenarios. In the first scenario, the perquisite or a benefit is provided wholly in kind. Here, the obligation of the provider is to debit the recipient's account with the amount of TDS where the recipient has credit balance. If no such credit balance exists, then the provider has to ensure that tax required to be deducted has been paid before releasing or providing the perquisite or the benefits. In the second scenario, benefit is paid partly in cash and partly in kind, and the cash component is sufficient to deduct tax. Here, the obligation of the provider is to deduct tax from the cash component that is available with him. In the third scenario, the benefit is partly in cash and partly in kind, and the cash component is not sufficient to deduct the tax. Here, the provider would debit the recipient's account with the amount of TDS to the extent the recipient has credit balance. If no such credit balance exists, then the provider is to ensure that tax required to be deducted has been paid before releasing or providing the perquisite or the benefit. In the fourth scenario, the benefit or the perquisite is provided wholly in cash. In this scenario, there is no obligation cast on the provider as the cash perquisite or benefit does not require deduction of tax under the section 194R. A related issue is the definition of tax for the purpose of section 194R. The first proviso requires that the payer has to ensure that tax required to be deducted has been paid. A question arises as to what is the meaning of tax. Is it the TDS under section 194R1 at the rate of 10%, or will the definition of tax in section 243 apply? In my opinion, the text and context in which the word tax occurs in the first proviso points to the tax required to be deducted under section 194(1) itself at the rate of 10%. The tax to be paid as per the first proviso before releasing the benefit or the perquisite is the tax at 10% that is required to be deducted, and it is not the tax rate of the tax slabs applicable to the resident recipient. In section 4, we explore the issue of timing of deduction under section 194R of the Act. Section 194R provides that it should be ensured that tax has been deducted in respect of such benefit or perquisite, and the operating clauses before providing such benefit or perquisite as the case may be to the resident recipient. Now, the liability can be discharged in many ways, and the examples are by the payer by grossing up and paying tax out of his pocket, by the payee by giving cash to the payer to meet the tax liability. Thirdly, it can be done by debiting the account of the payee if it has a credit balance, so that amount will be paid net of TDS under section 194R wherever credit balance is paid to the payee. It is to be noted at the outset that the option of taking declaration from the payee that he will pay the applicable tax under section 194R does not exist, as such a promise falls short of the expression to ensure that tax has been deducted, which is the duty cast on the provider of the benefit or the perquisite under section 194R of the Act. So a promise given by the recipient is not sufficient compliance under section 194R of the Act. Two critical issues for discussion here are: number one, at what point does the providing happen? The word provide, provided, or providing has several shades of meaning. The best reference, in my view, is the judgment of Delhi High Court given as far back as 1984 in CIT versus Baba Singh Chauhan and reported at 16 Taxmann 180. In this judgment, the court held that no benefit is provided until the benefit in question becomes available to be enjoyed by the taxpayer, in respect of which a charge to tax can arise. Becoming available for enjoyment of the recipient is the critical factor. The arrangement made by the provider, or the steps taken by, or the cost which is incurred are not relevant touchstones for determining whether or not a benefit has been provided in terms of its availability to the recipient. The second core issue is at what point deduction is to be ensured and how. It is a foundational and pragmatic issue to implement the provisions of Section 194R of the Act. Let us once again examine the example of foreign tour promised by a company to its dealers and distributors who achieve the set target. The following stages are encountered in the delivery of the agreed promise of a foreign tour. Number one, a provision is made in the accounts of the provider company for the estimated cost of the foreign tour to those dealers and distributors who have achieved the set target. Number two, the dealer or the distributor intimates the foreign destination he wants to proceed and the date when he wants to do so. The third stage is when the provider company makes payment to the tour operator and books the foreign tour. The fourth stage is the tickets are handed over or emailed to the dealer or the distributor. And the final stage is the departure of the dealer or the distributor to the foreign destination. In the above example, it seems prudent to deduct tax at the third stage, that is, when the payment is made to the tour operator. Gross up the amount paid to the tour operator by 1/9 of the amount from the sum grossed up. 10% will be TDS to be deposited with the government. This can be done as provided by Section 195A of the Act. But what are the implications on the cancellation of foreign tour by a dealer or a distributor? Section 194R is about providing the benefit or the perquisite and not about its availment or enjoyment by the resident recipient. TDS deducted cannot be claimed as a refund even if the tour is cancelled by the resident recipient. TDS will not be refundable even if cancellation provides reduced benefit in cash to the resident recipient or provides zero cash benefit in lieu of the tour. Now, given this situation, it would be better if CBDT clarifies with FAQs and examples in its removal of difficulty guidelines, which it can be issued under Section 194R2 of the Act in respect of various perquisites and benefits. The clarification would be whether, how, and at what stage Section 194R is to be complied with. Let's consider another scenario where it is a case of continuation of a benefit or a perquisite to a recipient over a time period. For example, a partnership firm provides rent-free accommodation to the partner. In this case, the perquisite delivery to the partner has various stages. Let's peel them. The first stage is when partners resolve to provide accommodation and decide on the rent budget. The second stage is when the partner concerned makes a choice of the accommodations available to him. The third stage is firm pays security deposits and enters into a rent agreement with the landlord. The next stage is the firm gets the possession of the premises which are going to be occupied by the partner. The next stage is the firm gives keys to the partner concerned, and the final step is when the partner concerned move in. Now, providing in a way is complete here in the period when the partner concerned moves in. But a question does arise whether tax from the value of perquisite for all remaining months of the current financial year should be deducted at this step itself. There is no harm in doing so, but it may not be the most prudent thing to do. If the rent agreement is cancelled before its term expires and the benefit is withdrawn, perhaps because the partner buys his own house or the firm moves him to a better accommodation, TDS will go waste. It remains to be seen whether CBDT, in its removal of difficult guidelines, provides clarifications in such matters. To sum up, in my opinion, Section 194R does not contain clear guidelines as to the point of time when tax has to be deducted. These are issues in which CBDT probably needs to be proactive and to issue a set of clarifications or FAQs which give exact point at which the TDS needs to be deducted so that unnecessary and repeated litigation on the timing of deduction of tax under Section 194R is avoided. Thank you. Happy listening till we meet after a fortnight again. Thank you so much and have a good day.